Can you hear me?
Hi, everyone.
Okay, good. So I have George. George is here. Hey, George.
Yes, I'm here. You had me muted.
Oh, I did. Tom.
Tom, you're muted too.
Boy, everyone's really. You're muted.
I shouldn't be muted, and yes, I'm here.
Good. Michael.
Here.
And I'm here. Who else do we have on the roll call, Diane? Diane. Diane.
He's muted too.
Diane, you're muted.
Hang on. Everybody on the
He's muted too.
everybody.
Diane, you're muted.
I just unmuted myself. Everybody that's on the committee is here. Brian Binkley's here from Vanguard. We have Ellen Kosensky and Rob Lassard from Hooker and Holcomb, who will be up first after you approve the minutes and approve a calendar for 2021, please.
That was beautifully said. Okay, all in favor of the minutes?
I'm in favor.
Okay. Yeah. That was beautifully said. Okay, all in favor of the minutes?
Yep.
In favor? Okay. Okay, so minutes approved. Meeting schedule. We have a tentative meeting schedule. It's probably going to stick, but we want to get things on. Minutes approved. Meeting schedule. We have a tentative meeting schedule. It's probably going to stick, but we want to get things on. So I'd like to get approval for these dates, and they're likely to change and not be as many, right, Diane? So I'd like to get approval for these dates, and they're likely to change and not be as many, right, Diane?
Yes.
Okay, so can I get a motion?
I move approval.
And then all in favor?
I second. Yep.
All in favor? Aye. Okay, so can I get a motion?
I move approval.
Okay, and then all in favor?
I second. Yep.
Okay, all in favor? Aye. So we've got that approved, the meeting schedule. Now the actuarial reports, right, from Hooker and Holcomb.
Okay, you ready for us?
Yep.
Yes.
All right. I'm gonna, do you want me to share my screen, Diane? I have the presentation here. Let me see if I can pull it up.
That would be nice.
Right. Let's see. Okay, can everybody see that?
Yeah.
All right.
All I see is a blank white screen.
Oh, you don't see it?
No.
Let's see. Are you seeing anything now?
No, white screen.
All right, let me stop sharing and try again. Okay, let me try again. I'm not sure what's going on. How about now?
It says yes, yes.
Oh, there you go.
Yes.
Okay, good. All right. So we're going to cover the actuarial valuation. We're going to focus, I think, just on the pension side. Just today, we added the OPEB slides to this presentation, but I don't think we're going to have time to cover those. We can certainly, if you would like, but our focus is going to, I think, mainly be on the pension side. So starting off here, the purpose of the valuations. Why do we do these valuations every year or every other year in your case? So the ultimate cost of a pension plan is primarily based on the level of benefits that you promise to the employees of the town. So the ultimate cost is what you see in that shaded box right there. It's the benefits that you pay, all of the benefits you pay out until the very last participant in the plan receives the very last payment. Added to that are the expenses that you incur from running this plan. And then the town's cost is offset by the investment return. So you let your assets work for you, so you don't have to contribute the full amount of those benefits to the plan, but you have this trust that the investment returns pay a good portion of it. And then you have employee contributions coming into the plan, which is also a direct offset to the town's cost. So employees do piece of their own benefits under your plan. So the actuarial valuation uses what we call a cost method, and it assigns a piece of this town's ultimate cost to the budget year. So the July 1st, 2020 valuation develops the actuarially determined employer contribution, otherwise known as the ADEC, for the 2021-22 and 22-23 fiscal years. It's made up of two components. It's comprised of the town's normal cost and the amortization of the unfunded liability. We're going to get a lot more into what those two pieces mean, because I know there were some questions about, given that the plan is overfunded, should you really be contributing the full ADEC? And we really want you to understand the components of the ADEC to sort of make a well-informed decision. So I'm going to turn it over to Rob. He's going to go through so the last time we did this valuation was back in 2018. We updated every 2 years. So Rob is going to go through what happened on the asset side and what happened on the liability side over the past couple of years to get us from 7/1/18 to 7/1/2020.
Thank you, Ellen. As Ellen mentioned before, we do this valuation every other year. So when we develop the assets, we're going to be doing 2 years worth of assets. The information that you see in the market value column is going to look very similar if you've taken a look at the GASB 6768 report. And if you look at the bottom, you can see a return of 6.6. That lines up basically perfectly with the GASB report, which returned 6.60%. So I'm not going to spend a lot of time in that column because it's basically just a beginning of year to end of year for the market value of assets. The second column, or the third column really, actuarial value is going to do a development of the actuarial value of assets, which is what the ADEC, the contribution, is based off of. So as you can see, most of the components are the same. Contributions are developed. Benefit payments and admin expenses, those are all the same. When you get down to item number 4, you can see that things are a little bit different. And so there's an item for recognized gains and losses. And basically what the actuarial value of assets is doing is it's smoothing in gains and losses that occur in prior years. And it's looking at the last 5 years, and it's going to recognize prior gains and losses 20% of the time over 5 years. So on an actuarial basis, it returns 6.0, so a little bit less than the market. Ellen, could you go to the next?
Yep.
Thank you. And then same thing from July 1, 2019 to July 1st, 2020. It's the same idea. As a comparison for the market value, you see 5.9 here. The GASB report turned 5.95. So some minor difference in interest, but nothing material. And in this case, there was a year of losses that came out of the smoothing for this year. So the actuarial actually returned a higher return than market. Could go to the next page.
So you're saying it's based on the last 5 years? I missed. What's it based on?
That's correct. So there's a base that gets created, which is based on market gain or loss. And over a 5-year period, the gain or the loss gets recognized 20% each year. And then by time equals 5, it's out of the equation.
And the expected return is based on the last 5 years as well?
The rate of return that you see on the last line item is for the current year. But for the actuarial, it's got the 5 years baked into it.
Yeah, but for calculating the ADEC, they use our 6.75% assumed rate of return on assets.
Oh, so the 9524 on net investment return, expected return, is that a 6.75 calculation to get to the 9524 number?
The expected return is 6.25. The actual is the 6.6. And so as a result of it being slightly less than the expected, it's going to drive the ADEC slightly up, which we'll go into on the next page.
Okay.
Yeah.
Okay, and then just as a refresher, I kind of touched on the first two. The actuarial value of assets is what we're actually going to use to come up with the ADEC. It's based on the market, but as you saw, there's slightly different numbers. We're doing a 5-year smoothing, which equates to recognizing 20% of it each year until it makes its way through. The market returns fell a little bit short of the 6.75 assumption, but they were pretty close. I mean, you had 6.6 and 5.9, so it's not like you were that much under. In comparison, actuarial value, you had 6.6 and 6.0. So again, those are very close, but you fell slightly short of the 6.75. So what this means in terms of the ADEC is an increase of what we were originally expecting of about $125,000.
I don't see that. I mean, in 2020, we were looking at $1,446,047. And in 2021, at least on the deck that I got earlier today, we were looking at $1,543,662. Am I looking at the wrong numbers, Robert?
Well, what we do is we do what's called a roll forward. We basically do the expected of what we think is going to occur. So we know what we have for our rate of return assumption. We know what the contributions, benefit payments, admin expenses were. And when we do a comparison of what we thought was going to occur and what the actual number is, there's a difference of 1.2 million for the 2 years.
So, okay, so now I'm confused.
I'm sorry.
In the if we scroll back up where we have the 4-year numbers, the ADEC for the 4-year numbers, maybe it's scrolled down. I'm not sure where it is exactly. There's a chart where at the bottom there are 4 years shown for ADEC.
So you're looking at the 1.64 million.
Yeah, I'm looking at page 10.
Okay.
If you go to page 10.
So
see, we see 20, 21, 22, 23.
Yep. So those are the actual ADEC numbers once we are done with, once we take into account the actual assets at July 1st, 2020, the actual liabilities at July 1st, 2020. And what we're doing back up here is kind of just giving you a sense of why your ADEC moved the way that it did. So Rob had kind of alluded to this. What we do as actuaries is if everything happens exactly as we expect it to happen, we have an ADEC number in mind that would be the true number because all of our assumptions came exactly true. That of course doesn't happen. Things move differently. The assets returned less than we expected them to. We expected them to return 6.75%. They only returned 6% in 1819 and 6.6% in 1920. So because that was short of the expectation, there was an increase in ADEC.
So, but my point is, if I take 1,543,662, and I subtract 1,446,047, I only get an ADEC increase of 97,615.
Well, we're looking at the 2022-2023 numbers. The 2020 and 2021 were developed with the last valuation back in 2018. So both of those numbers came from the July 1st, 2018 valuation. So we're going from 2021, you were at 1,543. We're going to 1,647. So
Okay.
those are kind of the two numbers you want to look at to compare of where you were and where you're going.
Mm-hmm.
But there's other things going on beyond just the 125. You have liability gains and losses in there. And then there's also an expectation that the ADEC would increase slightly over where it was last time because employees have received salary increases, additional benefits, accruals, things like that. So there's a lot of pieces that go into the ADEC number.
Mm-hmm.
The assets are one of them. So this is what just the assets did to your ADEC, but there's other pieces as well.
Okay. So since we're the Board of Finance, what the real question I was trying to grapple with just now is for fiscal year 2021, how big a check do I write?
That would be the 1,543,662. That's
So
your
that-
2020,
okay.
2021 contribution.
Okay, so that means that our ADEC went up by $97,615.
But that's a number that was developed with the 2018 valuation. We have a lag in place because of the fact that the valuation is only done every other year.
So in 2020, we did not write a check for $1,446,047?
You did, but it wasn't based on anything related to the 2020 valuation. And similarly, the upcoming year was also based on the 18 val.
Oh, okay. I'll bow to your superior knowledge.
Oh.
I'm not buying it.
The 2020 and 2021 ADECs, those were set 2 years ago. Those have not changed. They were based on your assets and your liabilities as of July 1st, 2018. So what we do is we update our numbers every 2 years, and then we give you ADECs for the next 2 years out.
Right.
So the 2020-2021 ADEC was set a couple of years ago, and it was based on information as of July 1st, 2018. That's just the method that the town has adopted. Is to update these numbers every 2 years versus every year. Some municipalities have a method where they do update the numbers every year, but New Canaan has chosen to do it every 2 years, which is perfectly acceptable.
So
I'm not challenging.
Will be for the next 2 years. The next 2 years will be 1,648 for 21, 22, as well as 22, 23 is what you're saying. It won't change.
Oh,
right.
That's correct.
Okay.
From a budgeting standpoint, it's easier to do it this way too.
Okay.
But if I could just ask, so doing these valuations now do two things. It not only sets the ADEC for the coming 2 years, but it also, taking into account all of the gains of the money that's already there and all of the payments that have been made and all of the new benefits that participants are entitled to, there's also a little bit of a catch up for what the actual ADEC would have been had we had 2020 numbers in 2020. Is that right?
You could say it that way.
Okay, but we're not saying that we have a fixed ADEC for the next 2 years. If you look on page 10, in 2021, it's $1,543,000, and in 2022, it's $1,647,000.
It not fixed in the sense it's not changing. It's just fixed in the sense that the number is known at this point. I mean, we can tell you right now that the ADEC for 2022, 2023 will be 1,742,124. That will be the number. We're not going to change that number no matter what happens to your assets next year or the year after. We're not going to change our 2022, 2023 recommended contribution. So it's fixed in the sense that it's known. It's not fixed in the sense that it's not changing from what it is today.
I think the big takeaway from that last bullet is that if all the returns had been perfectly met, the numbers that you would see for 21-22 and 22-23 would be approximately $125,000 lower.
Okay.
Okay, so that kind of covers what happened on the asset side over the past 2 years. Are we good to keep going, or did you have other questions? Yep. Keep going? Okay.
Yep.
Okay, I'll turn it back to Rob.
So now on the liability side, and liabilities is just the present value of all the benefits that you're paying or will pay. We do an analysis of that in the same way we do what we call a roll forward, where we've got all of our assumptions in place for salary, how people are going to retire, pass away, terminate, etc. And we come up with what we think the number is going to be as of July 1st, 2020. And then we'll physically run the 2020 valuation, we'll get the actual number, and we'll analyze the difference. And in this case, it actually resulted in a gain of 0.7 million. So this offset the loss on the asset side. The loss on the asset side was about 1.2 million. And then this gain, the offset, is about 0.7 million. So the largest source of the gain was that we have this assumption for salary. We have a salary scale assumption, and the increases were lower than we expected. And then offsetting that, there were some losses related to liability, which had to do with fewer retirements than we had expected, and fewer retiree deaths than we expected. Are there any questions on that?
So are we going to be netting the 700,000 against the 1.2 million?
Yes.
Of underperforming gains? Yeah.
So even though you had a shortcoming on the asset side, the liability gains will help you out with the Adec.
Right.
Okay, so when Rob was just talking about the liability, the expected liability, that was assuming we do not make any changes to the assumptions that we used back in 2018. There are two assumptions that we are recommending be made this year. The first is to lower the inflation from 2.75 down to 2.5. This is kind of consistent with some updated long-term projections of inflation. And what this impacts is how your salaries are expected to grow in the future. So we're essentially expecting salaries to grow 0.25% less in the future than we previously were. So this serves to lower the liability by making this assumption change. The second assumption change actually increased the liability. It had to do with the mortality assumption. The Society of Actuaries released some new tables. I think we mentioned this back in 2018. They were very new at that point, and they've now been finalized. They're mortality assumptions that focus just on public plan participants. So all previous studies had only taken into account private plan data. And this was the first study that now takes into account public plan data. So it's more applicable to your plan being a public plan. So we would absolutely recommend that this change be made as well. The mortality assumption had an increase in liabilities, which is consistent with what has happened on all plans based on the new mortality assumption. So the combined effect of the changes was actually a 1.4 million increase in liability, and that translates into a $70,000 increase in Adec. So we had some losses on the assets, some gains on the liabilities, and then some losses as a result, mostly of the new mortality assumption. So on the next page,
can I just stop you for a second, Ellen? So I just want to make sure we're in sync. So we saved 700,000 on the liability piece on the page before, but now we have a 1.4 million increase in liability because of these change in assumptions. So the net is our liability is going to increase by 700,000 on top of our asset shortfall. So we have two things working against us: our asset shortfall and an overall combination of liability has gone up from 138.4 to 139.1. So the net of the liabilities has gone up by about 700,000. Is that correct?
Yes. Yep.
All right. So we have a 700,000 increase in liability, a 1.2 million shortfall in assets. So about a $2 million deviation total if you take those two together. Is that, am I doing the math right there?
1.4
short in the assets, right?
Yes.
And
yes. I think that's correct.
That is correct, yeah.
I just want to make sure everyone's on the same page there. So we're $2 million short. Got it. Okay.
So when you put all of this information together, that's what gets us the ADEC results that you see here on page 10. We've kind of already looked at these numbers down on the bottom, but the final ADEC for fiscal year 21-22 is that 1.6 million that you see. The final ADEC for 22-23 is the 1.74 million that you see. So some of the other, what you see in the right-hand column is July 1st, 2018 valuation results. The updated 2020 results are in the left-hand column. The funded ratio, you can see, came down slightly from 107.7% funded down to about 105% funded. Still very well funded at over 100%. But again, the funded ratio did tick down slightly because of that. As you had just mentioned, you know, the assets didn't perform exactly at 6.75, and the liabilities were up slightly versus expected, which brought the funded ratio down slightly.
I had one quick question, Ellen,
Sure.
and if it's not a quick answer, then we can just maybe do this offline. But I know that in the two assumption changes that you had recommended on the prior page,
yeah,
the inflation assumption, were we to adopt it, would have effects for each year going forward, right? But is adopting the new mortality tables, once we adopt it and we climb on that rung of the ladder, are we good, or does that impact hit every year?
No, you wouldn't see an increase in your liabilities every year. You're kind of absorbing that increase this year, and then going forward, it's, you know, just experience what happens to plan participants. But no, you wouldn't see an increase like that every year.
Okay, thank you.
Sure. So the next page, I know there have been some questions about whether or not the plan should be contributing the full ADEC, given that you are over 100% funded. So we wanted to try and answer that question here. And what it really comes down to is kind of understanding the numbers that go into the ADEC. So we had mentioned previously, it's made up of two pieces. The first piece is called the normal cost. Now that represents the value of benefits that employees are expected to accrue in the upcoming year. This piece of the contribution is only attributable to your active employees. Your retirees, your terminated vested, their normal cost is zero. They are not contributing to this part of the contribution. This is strictly due to the fact that employees are going to earn another year of service. They're going to see an increase in their salary, which will drive up their ultimate benefit because the benefits are related to salary. So the normal cost can be thought of as the annual kind of cost associated with the plan being an ongoing plan. Now the normal cost is $2.74 million. As I had said previously, employees contribute to this plan. So the money that they contribute directly offsets the town's cost. So the total cost of what employees will accrue next year is $2.74 million. Employees contribute $0.6 million of that, which leaves the town with a normal cost of $2.14 million. That can be thought of, again, as the annual cost associated with this plan. So we're telling you that's the annual cost of the plan, but then we're telling you that the ADEC is only $1.647 million. So how are we kind of reconciling those two pieces and telling you to contribute less than what the plan really costs? That comes from the second piece of the contribution, which is the amortization of the unfunded liability. The unfunded liability is just the difference between your assets and your liabilities on the valuation date. Because the plan is overfunded, this is actually a negative number. So it's negative $7 million is your unfunded liability. So plans have to have a method. Usually the liability would exceed the assets in most cases. That's not the case in New Canaan because you are over 100% funded. But there has to be, if your liability is less than, or if your assets are less than your liability, you have to have a way to close that gap and make them equal to each other. There has to be a method for making them equal, because at the end of the day, your assets have to equal your liability. So what New Canaan has, the method that New Canaan has for making those two pieces equal is to amortize it over 15 years. It's basically like a mortgage. Your unfunded liability is $7 million. You pay it off over a 15-year period, and at the end of the 15 years, your assets equal your liability. In New Canaan's case, because the plan is overfunded, it's actually a negative amortization. It's a minus $0.7 million piece of the ADEC. So we subtract that from the annual $2.14 million normal cost. So when you bring the question of whether you should contribute less than the ADEC because you already are overfunded, my actuarial opinion would be you should not reduce the ADEC below what we recommend, because we are essentially already doing that. Right. We're already making up for the fact that you are overfunded by reducing the annual cost.
Yeah, Ellen, that wasn't actually, I think, from our last meeting, what we were going to ask you guys to take a look at. What we wanted to know is if we reduced our return assumption from 6.75 to say 6.65, then what impact does that have on the amortization of the excess assets over excess liabilities over the 15-year amortization period? In other words, and then how would that roll into whatever changes in an ADEC allocation might have to be made? Because we're concerned that 6.75, or at least I'm concerned that 6.75 is increasingly at odds with projected returns available to us in the financial markets.
Okay, so if you were to reduce the investment return rate, that would increase your liabilities. Yes. So that means your liabilities would be higher, your assets would stay exactly where they are. Yes. So that unfunded amount of 7.3 would be low. That would shrink. It would be something less. Yes. We have in here, I'm just going to skip ahead right here. So we're showing what the ADEC would be if you were to reduce it to 6.65. So your ADEC would go from 1.647 for 21-22 up to 1.88 million for 21-22. So it's about a $200,000 increase. Yep. So that means that the amortization piece is coming, the offset is coming down by about $200,000.
So our required ADEC contribution would be up by about rounding about $250,000.
Correct.
And that would buy us.
So our required ADEC contribution would be up by about around $250,000.
Yeah,
correct. And that would buy us.
That would buy us a 10 basis point reduction in our assumed rate of return.
Correct. Yep.
So is it monotonic? Is it consistent? If I said,
10 basis point reduction in our assumed rate of return.
Right. There's an
Correct.
on the line.
Yep.
So how about
Is it monotonic? Is it consistent with, okay.
how about if we said we wanted to go to 6.7? Would that only be then half of 233?
Essentially, yeah,
Very linear.
roughly.
Okay. Thank you.
Let me ask you a question, Ellen, because from a market's point of view, which I get involved in on a regular.
I am, excuse me, gentlemen, I'm just going to interject because
from a market point of view, which I get involved in on a regular. So just sorry, I was going to ask a question, Ellen, just from a market's point of view, because I kind of study this on a regular basis. I understand that we haven't hit our 6.75. But I also understand we haven't hit the inflation rate, and that's why we're reducing the inflation rate from 2.75 to 2.5. Your inflation rate that you've analyzed, what has been the inflation rate over the last 2 or 3 years that caused you to reduce it from 2.75 to 2.50 going forward?
Well, we look at long-term inflation expectations. So we're talking, like 30-year expectations.
I got that. I'm just saying, what has it been over the last 2 or 3 years?
Oh, over the last couple of years, I want to say it's been in the low, probably somewhere in the low 1% range.
Right, which is what I would have thought it would be. So what I'm trying to get at, George, is one of the reasons we haven't hit our 6.75 is generally there's a market over inflation. So you subtract out 1% over our 6. So I wouldn't take it down from 6.75 to 6.65 without taking out inflation rate down, because I think 2.5 is still high. So if you don't think you're going to hit 6.75 next year, that's a fair point. But I don't think we're going to hit 2.5 next year on inflation either.
Right.
So there's an argument to say, don't take your rate of return down from 6.75 without a corresponding taking the inflation rate down, which would offset some of it.
But I think that's what we're talking about, Michael. I mean, if you're saying that the real rate of interest plus the inflation premium, and inflation premium is going to be lower than we thought when we set 6.75, then we should reduce 6.75.
No, I just think inflation at 2.5 is too high. That's what I'm trying to get at.
Okay, but that would just make it even worse then.
No.
Yeah.
No. What I'm saying is they're assuming 2.5 now.
Right.
And 6.75.
Right.
So what they're assuming is a gap of about 4.25.
Yeah. They're saying real rate of interest is going to be 4.25%.
Correct. What I'm saying is, let's just say I think 4.25 is not unreasonable. So I think it's actually probably higher than 4.25 in my view. Okay. So if it's 4.25 and you take the return rate down from 6.75 to 6.50, I would say you're ultra conservative, because I don't think 4.25 over the inflation rate is an unreasonable rate of return. And what I'm saying is, in the past, when we've returned the past, for example, we returned 6.5% in the past with an inflation rate of 1%. So we've returned in the past 2 or 3 years about a 5.5% rate of return over inflation. So going forward, an assumption of return of only 4.25 is a pretty conservative assumption given what we've experienced over the last 2 or 3 years.
Well, yeah, if we were just talking about equity returns, I'd absolutely agree with you. But the pension plans invested in bonds and U.S. domestic equities and then international equities, right? So I don't know if then 4.25 is a reasonable assumption. I just don't know.
So we should look at that. Obviously, before we take the rate of return down, you have to balance it with what our inflation return is and what we've done.
Yeah, and I was asking just a what if kind of question, because I'm concerned that 6.75 is not sustainable.
Okay, we have a 15-minute warning.
Sorry, go ahead.
I think we better move along or continue at another meeting.
Now keep going. But I was just trying to make that point. It's correlated inflation. If inflation is lower, you're going to expect a lower rate of return. If inflation ends up being higher, you could get a higher rate of return as well.
Okay, let's move on then.
Inflation saves a lot of problems, that's for sure.
Yeah, I agree, actually, George.
Right. Right.
So I think the rest of our presentation, this page just goes through the pieces of the ADEC. I won't go over that. And the rest of the presentation on the pension side, it just has to do with some statistics around the state of Connecticut. So in the interest of time, I can certainly go over them, or if you just want to read them on your own, that's fine too. If you want to move on to the rest of your agenda, just let me know.
Well, this is going to go to the full Board of Finance next month, so everyone knows. I assume that everyone's in favor of accepting the two things, the mortality rate and the inflation rate, or maybe there's some debate on that, I don't know. And then there's the discount rate. So opining on that before it goes to the meeting would be good, although we could go to the Board of Finance and have that discussion there too. But how do people feel about those decisions now?
Yeah, I'm okay with the mortality rate. I'm okay with the change in inflation. I'm hesitant to take the change in the return rate to the full board for a discussion until maybe we do a little bit more digging on this. I'd like to defer talking to the full board about that until we can chew on it a little bit longer.
Okay, so how will you do that? The board meeting's in January.
Right.
And that's the traditional time we do it. Would you want to have a meeting separately off?
Yeah, I think you know the advisory committee can get together on a Zoom call and we can kick it around without.
Right. And you know we could even have that debate with the full board. In years prior we had the discount rate. We have, you know, that has been a topic of many times. So okay. That's another way to do it.
I'll do whatever you say, Mr. Chairman.
Really?
Yep.
Okay. All right. I think that's good. We have one aspect. Mike or Tom, any other points besides that?
I think George. I would just comment. I think George is right. I think I don't have an issue with the mortality rate. I think 6.75 is a little high. I agree with George on that, but I think the inflation rate is a little high too. So all I'm just saying is what we should look at, whether separately as this advisory committee or in front of the full board, is look at both those numbers, because I think my personal opinion is they're both high.
Yeah, and I look just to follow up on that. I agree with both Michael and with George. Fine with the mortality. Probably going to be okay with the inflation, but I do agree that we should develop our thinking a little bit more, because the more we dig into the rate of return assumption, the more we might come back to Michael's point about.
And hi, I was just going to say, as it relates to the rate of return forecast that we at Vanguard provide, that is a nominal number, so that includes an inflation. And the inflation assumption, whether it's 10 years or 30 years, are both less than 2%. So we have a much lower inflation target, and that'll vary from firm to firm. We're probably lower than, I'll call it the median out there, but I just would want you all to be aware of that.
And I agree with Brian. I think inflation is my personal view, is going to be what Brian is assuming versus doing it.
Okay. So, well, I think we'll end up getting back together in some form, if we can, in a Zoom call or something, and have some discussion. But again, we can bring it to the full Board of Finance too. And maybe we'll decide to do that, but like we need another call, just a call. So, all right. Okay, moving on. What do we want to do with the Marsley Fund? George, you kind of own this one.
Go, George.
Okay, so just to be clear, I am only talking about the Marsley Fund. I am not talking about our pension plan. All right, because I view those as having two reasonably discrete but separate investment objectives. The Marsley Fund's objective is in a prudential manner, without adversely impacting the corpus of the assets, to generate the most available cash from dividends that we can prudentially, so that we can provide the largest set of scholarships, which was the purpose for the Marsley Trust being set up to begin with. So based on that, last time we had a meeting with Brian, I thought came up with a reasonable kind of rebalancing of how we looked at that. We can drop the duration down a little bit. We have a modest impact pickup in potential credit default risk, and a reasonably okay return on the repositioned assets. And I would go with what Brian presented the last time we talked, unless people think that that's not what we should do and we should just stay with what we have.
Well, one question first is it worth the money? I mean, you know, we're not talking about big bucks here. Is this, you know, I know you would want to stretch for every dollar, especially if it's going into scholarships. But we're not talking about much money here, and it's performed well over time so far.
But I don't think we're picking up a whole bunch of extra risk either. Brian, you can correct me if I'm wrong here, but my understanding from your presentation was this was not we're not going to Vegas and hitting the crap tables.
Right. So there's increased risk from where we are in the fixed income portfolio, but it is all investment grade bonds. So we're not stretching. The only other point in where we are in the market cycle is those yields, even on corporate bonds over treasuries, are very compressed right now because of this environment that all investors are facing. And so the additional yield over treasuries is very minimal right now. It's close to historical tights. Mm-hmm. So this as a strategy, you know, we endorse and we implement for clients that are looking for additional return or income. And then the other thing just to be cognizant of is right now in the market cycle, and I don't, nor does Vanguard know how to presume when it would widen or when to time it, but being recognizing, I think Neil's point is that there's not a lot of additional yield. So I know I'm saying two things. We support using investment grade as a way to enhance return. Being cognizant of where we are right now, we're not getting much additional yield because of where we are in the market cycle.
Mm-hmm. Right. And you know, the question of doing BBB corporate bonds, they may be investment grade, but that's still down, you know, still up on the risk scale.
Yeah. And it's not all BBB. It's, you know, it's a mix.
Well, I think last time you said there were 2,100 issuers in that fund.
Yeah.
There's in 21. Yeah, that's correct. And it's in there. So there's lots of issuers.
BBBs, yeah. I mean, how many of them can be BBBs and still be investment grade? I mean, I guess they all could be BBBs, but that doesn't seem to be.
Well, there's probably some parameters on that. What is it?
I think it's just.
It differs from each fund. For instance, you know, if I'm looking at the intermediate term investment grade fund, about 30% or so is BBB. You know, the breakdown is all in the presentation. There's 43% is A, and the rest is A or better. So it's a mix across the curve. The bottom line is when you move to investment grade, there's additional risk. The best way to articulate this is over long periods of time. We think that is a compensated risk. That's what the data has shown. But being cognizant of in times of stress, like the first quarter of this year, you saw those spreads blow out, didn't do as well as the Barclays Ag because there's more treasuries. And then since then, the returns have been stronger.
Mm-hmm. Mm-hmm. Yeah, I'll tell you, Neil, in my view, what Brian had recommended, it just seemed much better aligned with the mission of the fund. And it seems to me that the analysis here, rightfully so, has been based on, well, you know, it's been doing pretty well. And so, you know, how do you make sure that the last 5 years were not an aberration and that we're not looking at data that is unduly distorted in one way or another? But generally speaking, it seems to me the mission and the goals of revenue generation and all the rest of it, it seems like it's very different than the pension and OPEB. And as a result, you know, why they were kind of marching along in lockstep with the same investment strategy, given the divergence of the goals here, made me think that this was a sensible thing to do. given the fact that it didn't seem to me on balance that we were incurring a great deal of marginal risk.
On the other hand, I know that Neil has made his living looking at investment grade stuff for a long, long time. So I'm hesitant to disagree with him on this kind of stuff.
If you looked at 1/3 of your portfolio triple B, you would fall over you looked at the quality of those credits. You know that, right?
Yeah, I took a lot of those credits to market, so I kind of know a little bit. Yeah,
you're the problem.
But did you say that 30% of that fund is in triple B, Brian? Did you say that?
I was speaking to the intermediate term investment grade, and in the presentation, that would be page 36. That was 31%. You have to realize, even in the total bond market, there's some triple B, but it's not as risky because most of the global, or the Barclays Ag, which is the proxy for the fixed income market, is 60% in treasuries or government securities. So there's still triple B in the Ag. Again, any of these are investment grade indices. Here we would just be moving a more concentrated position into just corporates.
I mean, I just don't see municipalities investing in corporates, but that's just my personal bias, you know, and the track record of those credits. You know, you fall off the cliff at the triple B, but it's a, you know, there's not an exact answer. That's just my view of risk perception. But for a municipality, for myself, I'd stay A and above myself.
I don't know, Michael. What do you think? I mean, I'm betwixt and between on this.
It's a great question. The question is, if it goes south, right? What happens? Who's accountable if it goes south? That's a real look. If it was my personal portfolio, and my personal portfolio is very bullish on equities, I put a significant amount of equities and have done so for a while, and it's paid off for me. But would I do that for the pension fund? No, because you know what? There's a different aptitude for risk. And so.
But this is the Marsley fund we're talking about.
So the question, I don't know enough about this fund to say, what is the aptitude for risk and who's accountable in case it goes south? Like Neil says, if you're triple B, I can imagine 2008 all over again, and these triple B credits would be the first to go, right? So is the chance of 2008 happening again? Slim, but it could happen. Yes.
It happened. Yeah.
So the question is, do you want to take on that risk? And I'm not sure. I personally, in my position, I'm more like, well, why take on this risk unless we get a mandate from someone that says, we want you to be more aggressive? And I don't think we've gotten that mandate yet. If we have, then that's a different story. Yeah,
because I think we're the only ones who can give us that mandate are ourselves, because we're the guys who manage this trust for. We're the fiduciaries for this trust.
Yeah, but do our clients, have they said their appetite for risk and how important it is? I mean, even though we might be the fiduciary, do we have any guidance on what their goals are and what they're trying to achieve and what's the loan appetite for risk? And without any guidance, I would lean with Neil and say, look, as a municipality, we got to be a little bit more conservative, even if our return level is lower than what the market is.
So maybe, I know there's another meeting coming up, Neil, and you can cut me off. And I think this was a worthwhile exercise because, you know, the point in the Marsley Trust is to grow the corpus. And importantly, we've grown the corpus over time. And that by default has led to a higher payout because all interest and dividends are paid from there. This was an exercise to look at, is there a way to get enhanced income? That's one. And I balanced that where we are with the risk in the cycle of being very tight. So there's not a lot of extra return right now. I think Tom said it best last meeting, you know, is the juice worth the squeeze? Is that right to give that to you, that credit to you, Tom?
I'll take it. I don't remember.
Okay, so then are we basically saying, look, we've looked at it because that's part of our job. We're supposed to take a look at this stuff from time to time, and we just don't see getting paid enough for increasing the risk profile?
Oh, that sounds beautiful.
So that sounds, because that's what you said. That's what you said last month, Neil.
And it's, and,
yeah,
and
look,
we could revisit it.
Yeah, look, I'd be fine with that. I think we, you know, this is a question we should be asking ourselves. And if the answer this time we asked it is not enough incentive for us to change, then it's a perfectly acceptable answer.
Yeah, yeah.
We can always come back to it.
Yeah.
Yeah.
I think that's fair.
I think we all agree on that. All right,
Yeah.
good. All right, that's pretty good. Asset allocation, we're not going to deal with now. And Brian, you're coming to our next meeting to do your presentation. We'll see you soon.
Yes, we're all logging off now, logging back in.
Yeah, we have a number, Diane. We have a number for the OPEB plus pension contribution for 2021's fiscal year 2021, and how much more that's going to be than it was last year.
She's on mute.
Diane, unmute.
For the OPEB, I just received it from Ellen today, and you know, we can address it later this month.
Okay, because that's what the board's going to want to know. They're going to want to know how much does it cost and how much more does it cost this year than.
Can you hear me? Am I?
That's what the board's going to want to know. They're going to want to know how much does it cost and how much more does it cost this year than it did.
The OPEB.
Right. And
it's not on tonight's agenda, to my knowledge. So I just got the report today from Ellen, and I'm not prepared to talk about what the what the contribution is.
That is the question.
But Ellen is coming back to the full Board of Finance at the January meeting.
Yeah, that is the question. You're right.
So maybe, Neil, that's another reason why perhaps we should try to meet before the January meeting.
Yeah.
To develop our thinking, get on top of the OPEB number, just so that, again, we don't necessarily have to decide and come to the Board of Finance with a recommendation, but we probably should come to the Board of Finance meeting with our analysis, kind of vetted, and we know what our positions or parameters are.
Yeah, I agree with Tom. I think we should have a meeting before the board meeting in January.
Yeah.
Okay, so we'll arrange that. We'll do a Zoom call somewhere. Yeah.
I will make sure we set that up.
Okay, that's great.
Perfect.
Good. Okay, let's adjourn this thing. If I could have a motion to adjourn. And goodbye, everyone.
So moved.
See you in a moment.
Yeah.
Thank
Bye-bye.
you.
Bye, everyone.
Thank you.
Bye.
Thank you.